If you're wondering if we're finally at the top of the housing market and how is inflation impacting the housing market here in San Diego, we're going to do a deep dive in this video and cover all those topics. Hey everyone, Curtis Chism with the Chism Team here in San Diego, and today we are going to be covering a deep dive of the housing market. And this is going to be a little bit of an extended video today because I really want to cover everything in as much detail as possible. So the first thing we're going to be taking a look at is basically there is a big spread between the bid price and the ask price. So what that means is what sellers are asking for and what buyers are willing to pay. There's a big difference between those two things. So essentially what's happening right now is we are starting to see a lot of price reductions in the market. So the overall housing prices right now are actually fairly stable. In April, we hit $1 million. In May, it actually dropped slightly and went to 990. So it's a reduction of about 1%. The data hasn't actually come out yet for June. That'll come out in another couple weeks and we'll see what happened, but I see a bit of stabilization. But what's been happening is sellers have been overpricing and now there's been price reductions occurring. So we'll see where that data leads us soon. But what's happening is a lot of buyers are believing that we are in a soft market, and there's a lot of buyers that have dropped out, which we'll cover shortly. But because a lot of buyers think that the market has softened, they're not willing to pay as much. So that's the difference between what they're willing to pay, and what sellers are asking for right now. So that's certainly creating some downward pressure on prices, at least as far as bringing prices back down in line with reality, versus before, for a while, it was simply we could overprice, we being sellers, agents could overprice and it would still sell for above ask. It's not really happening so much more. There was a study that just came out, some data that just came out from Redfin showing that there's been about 15% of the homes on the market have had price reductions in San Diego. And obviously a big reason for all this is inflation and mortgage rates. We have gone from about 3% mortgage rates to about 6% in just a couple of months. So this has cut a lot of the buyers out of the buying pool. Now, as buyers fall out of the buying pool, that means they're going into the rental market. So that's actually driving rent prices up. I'll touch on that a little bit more here soon. And then of course, mortgage rates are driving mortgage payments up, of course. So that's creating downward pressure on prices. The other thing we're seeing too is that homeowners aren't moving as frequently now, because for a while there was a great opportunity to trade up or downsize or relocate, that sort of thing. Now it's really not out of want or desire to move, it's just purely out of necessity. So if someone really has to move for a specific reason, whether that's a job relocation, a divorce, or they just really need to be in a smaller home or really need to be in a larger home because of a growing family. Otherwise, those sort of lateral moves within the city just to be in a better area aren't really happening right now, because homeowners, most likely you probably refinanced at 2.5%, 2.75%, maybe 3%, and you're not going to trade that in most likely for a 6% mortgage. Now, secondly, we're going to look at when are interest rates going to stop rising. So traditionally, mortgage rates are seemingly tied, really just correlated to the 10-year treasury. And a lot of people believe that they're directly tied to the federal funds rate. None of this is really true. Those certainly correlate and impact rates, but they are not necessarily the primary driver. Now, over the last 40 years, in a non-inflationary environment or non-high inflation environment like we've been in, then they are correlated. However, in a high inflationary environment like we're in right now, with inflation being right around 8% or so and likely growing, mortgage rates are actually tied more directly to inflation. So inflation becomes the leading indicator of where interest rates are going. So basically, when banks are lending out money, of course they need to make a profit. They're not going to be losing money. So they need interest rates, they need mortgage rates to at least match inflation or be ahead of it. And that ultimately will help tame inflation as well. So right now we're about 8.4% inflation. So most folks that are in the masterminds that I'm a part of, they're seeing mortgage rates likely rising at least to match inflation. And inflation does appear to be on the rise based on, of course, how inflation is figured, where it's dropping off lower inflation months from a year ago and adding in the higher inflation months from a year ago. So we're going to start building and inflation will rise a little bit more and mortgage rates will start to rise as well. Now, although I said that the federal fund rate does not directly correlate and impact mortgage rates, it certainly does have an impact still. And so when the Fed meets in July, they're likely going to raise rates again. The market will probably price in an increase before that meeting, and then it might dampen down again. That's what just happened. Wow, there was a lot of news around the federal fund going up 0.75%. But what actually happened is once they did that, the interest rate dropped slightly because it had already been priced in expecting that, kind of expecting the worst, and then it kind of calmed back down. So we were at about 6.3, 6.4% for a 30-year fixed mortgage, and then it fell to about 5.85. So that's kind of where we're hovering right now for a mortgage rate. What's going to have to happen is that most likely mortgage rates are going to rise to meet inflation. So sitting around 6%, it's very possible that mortgage rates could go to 8%, maybe even 10% to match inflation. What's going to happen when that occurs? We don't really know. I think we're in for a bumpy road for sure, considering we've had so many buyers drop out of the buying pool already at 6%. Once we get to 8 to 10, probably quite a few more will drop out. Now, most likely what will happen is that the Fed ultimately will continue to raise rates to try to dampen down inflation, but real inflation will start to fall before the federal fund has fully gone through all their mortgage rate increase or their federal fund increases, and then actual mortgage rates will probably start to fall off before that, and we'll start to see mortgage rates come down and then buying activity pick up again. Thirdly, let's touch on rents and what is happening with rents. So rents actually are rising right now, and the reason for that is because mortgage payments are rising. Now you can charge more for rents to match that, because when it's cheaper to own a home, then you're basically turning your renters into homeowners, right? Because it's cheaper for them to go buy a home. So if it suddenly is more expensive to own a home, then you're gonna be renting. But landlords can raise rents to essentially match mortgage payments. And so as mortgage payments get more expensive because of the rise in interest rates, now, of course, rents can go up as well. We are seeing a rise in rents, and because there are more renters that were gonna be buyers that have dropped out of the buying pool and now have become semi-permanent or potentially permanent renters, that is again increasing the amount of demand for rentals here in San Diego. And that's going to, of course, drive more demand, and there's limited supply, and rents will continue to rise. So we actually saw this in 2008 when the housing market very much crashed, that rents really skyrocketed 2008, 2009, 2010. Before that, rents were fairly reasonable in San Diego, and it really shot up because so many people unfortunately lost their homes and went into the rental pool that there was huge demand for rentals and prices went way up. We're starting to see that now, not because of a housing crash, but simply because people that were already renting are continuing to rent, and the landlords know that mortgage payments are higher, and so you can charge a little bit more for rent. So because of rent control limited 10%, it is capped at that, but it also allows landlords to just go right to that without much competition. Now, the other thing we're gonna see as a result of this, of course, is that, of course, people need money to live on, and so there's going to be more demand for increased wages, of course, and this is going to put a big crimp on the working class in particular, and those that are renting. So it's going to be a huge struggle for folks moving forward, of course, with rising inflation eating into grocery budgets and gas budgets. You have to decide, you're going to eat out, you're not going to eat out. You know, there's a lot of choices, very hard choices are going to have to be made. And this is going to increase inflationary pressure as wages do, of course, rise. This is going to increase inflationary pressure, which is exactly what we're trying to counteract. So we'll see how this actually all plays out. Now, fourthly, if you are a non-owner occupied owner, meaning you are a landlord, then you have a choice to make right now. Being that we are at the top, near the top, maybe on the backside of the top, what do you want to do? Do you want to ride out another 10 years as we go through a dip and then things come back as cyclically over 10 years? You know, I think that's a safe prediction to make, is that over 10 years, things always rise in real estate. So are you ready to hold on for another 10 years? Or are you looking to cash out now, being at the top? Even if we're at the back end of the top, you know, there's a saying that no one ever went broke making a profit. So if you have experienced a lot of appreciation in your property, and even if we're on the back end and you're taking 10% less than what was the top when your house might have been worth more, you still are making probably a pretty good profit. So you just have to decide, do you need that cash now? Do you want to reinvest that somewhere else? Or do you want to hold on for 5 to 10 years and see what happens and continue to take your rent payment? So that's just a decision that you'll have to make if you are a landlord and decide what you want to do there. Now, for some market predictions, I will say firstly that I do not have a crystal ball. I do not know the future. So these are thoughts that I have been formulating as I've been watching the market and as I've been communicating with folks that I mastermind with. So I make a point to always mastermind people that are far smarter than me. I try to be the dumbest person in the room and learn from others. If you find yourself the smartest person in the room, it means you're in the wrong room. And so these are thoughts that I've been taking from a lot of other people as well that help form what I'm about to say. So essentially, most likely we are in for bumpy roads. I think that's pretty obvious. We haven't even talked about the stock market, crypto markets, things like that. With the amount of buyers that are falling out of the buyer pool because of this rapid rise in mortgage rates and what will continue to rise, that's certainly going to be creating downward pressure on prices. Now, as I mentioned before, we're already seeing price reductions. We don't know exactly where the median price is falling in San Diego at the moment, but probably in the next 30 to 60 days, we'll probably have a much better idea of where things are going as far as, are we at the very top of the market? Are we on the back side of it? And kind of where are we at right now? I will say that we had so many offers as the industry had so many offers on homes. There were so many buyers that were not enough homes for folks. And so that's how there were 20, 30, 40 offers on homes. We can lose 50% of those, which we already have, and still be fine. In fact, there are still homes that in general are getting 3 to 5 to 10 offers on homes. That's still very strong. It still means you have to be very competitive with your offer. So what's happening is these price reduced homes, these are just way overpriced and they're having to come back down to earth right now. Now, there are really hot pockets in San Diego, such as Ocean Beach, for instance, right now. I'm representing someone there and we're having to be extremely aggressive and competitive to win our bid. We're getting outbid with multiple offer situations, and even though we're going in very aggressive on a lot of terms. But then there's other areas that are softer, like Scripps Ranch, for instance, has softened up quite a bit. So it really depends on the area of San Diego and the specific home as far as what's happening. If it's still a highly desirable home, it's still getting a lot of offers and is going quickly. If there are inherent issues with the home or the neighborhood, then that's softening up quite a bit. So we're certainly going to see, as mortgage rates rise, and as I mentioned before, I think we're going to see easily mortgage rates at least at 8% soon. And we don't really know how big of an impact that's going to be. So I would say buckle up and get ready for some opportunities as things come up as far as being able to purchase. But I am here to serve you and to inform you of what's going on. So a lot of agents right now have no clue what's happening. Unfortunately, they're not surrounded by leaders in the industry that can help guide. And so I am here to provide the information and inform you so that you can make the decision that is best for you, whatever that might be. I'm not here to make a decision for you. I'm not here to tell you if it's a good time to buy or sell. I'm just here to provide you information as far as what's going on in the market. And then you have to decide for you and your specific needs if that makes sense. So either way, I'm here to help you, guide you through your real estate needs wherever you might be in that process and the journey. I would love to talk with you more about that. Should you have questions, I would love for you to email me your questions, or if you're watching this on YouTube, you can drop them in the comments, but shoot me an email and let me know what questions you have about the market. This helps me create these videos for you and provide the best possible information for you. So in the meantime, I look forward to seeing you on the next video, and we'll talk soon.